Well, hello and welcome everyone. Today's topic is going to be retirement planning for farmers and ranchers. My name is Joel Schumacher. I'm an associate specialist with Montana State University Extension. So over the next half hour or so, we're going to talk to you a little bit about retirement planning and some issues that are a little bit different for farmers and ranchers than maybe for the average worker in the U.S. economy. One thing about the retirement system that makes it a little bit different for farmers and ranchers is just that oftentimes employers sponsor retirement plans. That's true here at MSU where I work, and both the employee and the employer contribute to the retirement account balance. Sometimes employee contributions are required, not always. But as a farmer or rancher, a self-employed individual, you're both the employee and the employer. So nobody's going to set that up for you. So it's really much more in your hands to determine what your retirement savings are going to look like. Another thing that's a little bit different is just, as all of you know, farming and ranching, and I'm going to use the terms interchangeably. It's more than just a job, right? It's a lifestyle. It's a more than an 8 to 5 kind of gig. So many of you are going to be much more entwined with your job than say a traditional worker in the economy. So you're also going to have a lot of your assets oftentimes tied up in the operations. So whether that's land, livestock, equipment, that's where a lot of the bulk of your assets are going to be. And then the twist on that really makes it a little different for retirement planning is oftentimes you've got family ties to this land and the operation. So in the sense that I'm not probably going to try to pass my job on to my daughter, but you might be trying to pass this operation on to your son or daughter, which means that simply liquidating those assets you've built up over your career to fund your retirement is a little harder if you're trying to transfer those assets to your son or daughter so they can run the operation. So little bit different planning perspective for retirement. So a couple kind of overview of the big picture, and then we'll kind of see how this fits in with farmers and ranchers. So the U.S. retirement system is really designed to have 3 legs, and that's personal savings, Social Security, and then an employer-based retirement plan. And as I just mentioned, the employer-based retirement plan is often a little bit harder for farmers and ranchers because they are the employer and they would need to set that up themselves if they wanted to utilize that. Sometimes you see a fourth bullet point, which is part-time work. So that can certainly be true, especially as the health of Americans has increased over the last 20 or 30 years for those, in their 60s, 70s. That might mean that they're able to work, in which case that might not have been true in the 1950s. Regardless of where you work, retirement planning I like to think about in kind of 4 broad steps. One being, where are you at now? What assets do you own? How old are you? What are your what's your status of things? And then 2, what do you envision your retirement to be? There's not a single vision of what the right retirement is. My vision of retirement might look a lot different than yours. And then third then is what tools do we have that can help us get from where we're at now to where it is we want to be. And then kind of that last step, which is probably the most important here is, once you've decided those things, let's actually put a plan in place and take some steps to work towards whatever that goal is that you set for yourself. So stepping back and kind of going through these on a little more step-by-step basis, where are you at now? List your assets. These are the things you own that have value. Land obviously can be a big one for farmers and ranchers. Improvements, whether that be things like grain bins or pivots or irrigation systems, all of those kind of things. You may also want to take note of mineral rights, vehicles or equipment, and then maybe, your grain or livestock that you've got on hand as well. Now, some of you may want to list your business assets separately from your personal assets, and that's completely up to you. And it may have to do with how you handle your, individual accounting. If you do keep your farm and ranch assets or investments separate from your personal life, that might be a good thing to do here. Or if you're part of a family operation where there's more than one entity and there is a reason to keep business assets completely separate from your personal. That list of assets should also include things like bank accounts, whether that be a CD or a checking account, and anything specifically you have for retirement assets. So an IRA, maybe you do work off farm, or maybe you have a spouse that works off farm. And then what you expect your Social Security benefits to be. You get a statement mailed to you as you get a little closer to retirement, but you can create an account online at Social Security's website if you want to get an estimate of what your benefits will be at age. And it gives you several options, 62, 67, as well. And then things like insurance policies, you want to list those. And then if you've got some other particularly valuable household items, maybe you've got a collection of some type, artwork, antiques, those kind of things that would be of monetary value. Um, don't worry a lot about, especially like land values or the value of what the vehicles are worth. Just take a quick guess. If you want to do a little bit of work online, that's fine, but don't think about appraisals at this point. This is simply listing what the assets is, and if you can put a dollar amount next to it, that's great. Also want to list the things, liabilities we have, so things we owe other people. So maybe you've got loans, whether it be real estate, operating loans, student loans, equipment loans, car loans, credit cards, whatever those might be. Maybe it's even a store credit, or even something like child support or tax liabilities you might have outstanding. So list the things we own, but also list the things that we owe to other folks as well. One thing about this list is don't make this a huge project. This is something that hopefully you can complete, in an hour, or less, or maybe you've got to find a statement or two, but keep it simple. Don't worry about the exact values for things, and then review this periodically and update it. This is going to be kind of your measuring stick to some extent to see how you're doing towards whatever it is, those goals that you set. We're going to talk about those next. If you make this a really detailed process where you're really worried about the exact value of your 1994 feed truck, chances are the list will be a big project and it simply won't get done. So I would definitely say err towards make it quick, make it easy, and then do it on a regular basis. All right, so now let's talk a little bit about what you envision retirement for you. Again, I can't tell you what the right retirement plan is for you. Everybody's situation's different, everybody's interests are different, everybody's family obligations are different. So there's lots of different things. What kind of activities do you want to do? I certainly know plenty of farmers and ranchers that want to keep doing the work they're doing until they physically can't do it. Maybe they do want to cut back, go from full time back to part time. I know a rancher that I knew growing up, and he sold his place when he was in his early 60s, and he went and was a hired man on the neighbor's place. And I think he enjoyed those last 10 or 15 years of being a hired man a lot more than running his own place, because he could still do a lot of those activities he liked, but he wasn't worried about the price of cattle or whether it rained. He simply went to work, got to do the day-to-day activities he liked, and he got a paycheck at the end of the day. So we also see folks though that do want to move to town and maybe turn the operation over to um, their kids or somebody else, or flat out sell the operation. Some want to be closer to kids or grandkids. Maybe they want to be snowbirds, or maybe completely relocate to somewhere else as well. So those are all fine things. Maybe they want to, enjoy things like more time at the golf course, or enjoying high school sports, or going to the coffee club, whatever it might be. Um, and then caregiving is the last one I want to mention there, and that could be true of even an older parent. So if you're in your 60s or 70s, you may still have an older relative that you'd be caregiving for, but maybe you're also going to help out with grandchildren as well. One of the reasons I think it's important to think about these things is they come with different price tags. So it's if you're gonna, keep working on the farm and go to the coffee club and check out the high school football game on the weekends, that's pretty low cost. You might even still be earning money during that time. If you're gonna winter in the Sun Belt in a $150,000 RV and not be working at all, that's a lot different price tag. So thinking about excuse me, thinking about these things is helpful in terms of figuring out how much money you might need to achieve them. All right. So once you've thought a little bit about what it is you want to accomplish, the next step is really to write these things down, discuss them with your spouse. I wouldn't necessarily say you have to share them with everyone, but if you are in an operation that has multiple generations, letting others know your plans, or at least discussing some of those, um, might be really helpful for them to plan appropriately as well. So if you're planning to sell the farm when you hit age 70, but your daughter is on the operation and making her living there as well, she might want to know those plans so that she can plan appropriately for her financial goals as well. So the other thing I would say about your retirement goal list, things might change over time. Maybe there's grandkids that aren't yet born that you're going to want to be a part of their time. Maybe you're going to have your health isn't going to be as good, so it's not possible for you to keep working. Maybe you took a 1 month trip in an RV and decided that was not what you wanted to spend your retirement doing. Um, but again, you can update these things, but I do encourage folks to write them down and then discuss them at least with their spouse. Once you've thought a little bit about what it is you want to do, and then you can start to think about, well, how much income am I going to need to do these things? Um, and then you can kind of create a plan to help get there. So I already mentioned a little bit earlier, if you want to travel, if you want to maintain a second home, have RVs, do those things, that's a lot more expensive than going to coffee on Friday mornings and going to listen to a band at the local bar, and going to high school sporting events. Those things don't cost a whole lot of money, but in the first group they do. So having some idea of what you want to do in your retirement can help you figure out how much money you're going to need. Now, another point I want to point out here, and there was an author, Michael Stein, that brought this up probably 20 years ago, and I've always liked kind of how he framed this. He talked about retirement as not being a single event, but as sort of phases of retirement. And what he called it was the go-go years, were your early retirement years when your health is good and you're able to enjoy traveling and doing things, but those are expensive. And then kind of the slow go years, you still do some of those things, but you stay a little closer to home. Those things are less expensive. And then kind of the no-go years, he called it, where you probably stay mostly in your community, maybe do some doctoring, tend to be less expensive, with one exception is if you do need nursing home care. This data I'm showing you here on the slide is from the Consumer Expenditure Survey, and this is the average household expenditure, so not income, but the amount that households are actually spending. And what we kind of see here is maybe late in their career or early retirement years, that 55 to 64 range, we're seeing about $65,000 a year going out the door of expenses. Early retirement years, it drops to about 52,000, and by the time folks hit age 75, it drops to about 40,000. So just another way to tell that same story, that oftentimes as we age, we do spend less money, partly due to our health and the activities that we're able to enjoy. So how do we get to this goal? So there's, again, we talked about at the beginning, there's kind of three legs of the retirement stool: Social Security, specifically designated retirement savings, and then personal savings, which might include things like the land, the equipment, the cattle and herd you've earned, and then also part-time work. And that part-time work is, I would say, a bigger thing than it was 30 or 40 years ago, partly due to longer life expectancies, but also better medical care that we can get that keeps us healthier during those years, so we're physically able to do more things later in life. So let's talk a little bit about Social Security. Social Security was never designed to provide 100% of retirement income at a standard of living that most of us would be comfortable living on. If you haven't started getting those mailed retirement benefit estimates, you can log on to socialsecurity.gov and create an account, and you can generate that for yourself. Your benefit is based on your work history. So the people that worked more years, they use the highest 35 years of your career. They do adjust it for inflation. So the fact that, in your 20s, you earned a lot less than now, adjust that for inflation, it still comes out to be a more comparable number. But if you reported very little income, which many farmers and ranchers do, on a typical year. That means you also paid less into Social Security, which means your Social Security benefit will be based on those lower, maybe than average earnings as well. So, but even if you were an average worker, let's say, the current average retiree is collecting about $1,500 per month for 2021. So you can incorporate that into your planning, but I would encourage you to use your own personal estimate rather than that average number. Now, Social Security has different points at which you can claim retirement. At age 62, you can claim your retirement, but it is called early retirement, and it reduces your benefit by about 30%, roughly, or 25% there. So it does, your full retirement age, though, does depend on when you were born. For many years, it was age 65. Back in the 1980s, they made a change that pushed that to age 67, but they didn't do it for immediately or for everyone. They had this kind of sliding scale based on the year in which you were born. So if you were born after 1960, your full retirement age is 67. If you were born in 1958, for example, your full retirement age is 66 years and 8 months. Now, any of these folks, regardless of when you're born, when you reach age 62, you are eligible to claim early benefits. Just your benefits get better every year that you wait. You also can continue to work past that full retirement age if you like. So whether your full retirement age is in that 66 or 67 range, you can also continue to work up to age 70 and not claim your retirement benefits, and they'll continue to increase your Social Security benefits for each year you wait up until age 70. Now, at age 70, it doesn't mean you have to retire. It just means that you can claim your Social Security benefits and work as much as you want to, and it won't affect your Social Security benefits in any way. So at age 70, it's really almost always advantageous for folks to go ahead and claim their retirement. If you're still working and claiming retirement benefits, that's okay, but it will reduce your benefits during that period in which you're working. So it is possible to retire and have a part-time job and have no impact. But if you're going to work full-time, usually it's best to wait to claim your Social Security benefits until you've either retired or reached the age of 70. Now, one question I always like to talk a little bit about is people say, well, is Social Security broke? Will I get any benefits from it? You periodically hear in the news that Social Security has a financial challenge. So what I want to show with this graph, this comes from the trustees report for the Social Security Administration, and they update this every year. This particular one is the 2021 trustees report. So what we see here is the black line, this darker black line, and here in the year 2000, you notice it was lower than the lighter black line. The lighter black line is the amount of income coming into the Social Security system. So that's payroll taxes. It's also earnings on the investments that Social Security owns. The black line is the amount they're paying out. So in the year 2000, the checking account, if you want to call it that, for Social Security was collecting more money than was going out the door. This wasn't necessarily a huge surprise. So the account balance for Social Security was building up. And then you see here in about 2008, we see the recession come in, and lots of older workers either lost their jobs or decided to retire. So the dark black line jumps up and it actually crosses the lighter line. And now more money is going out than is coming into Social Security. So now we're drawing the account balance of Social Security down. And if you can see here in 2020, that continues to be the case here today. And it's projected to continue to rise and then kind of level out in about 2035 or so. And part of what we're really seeing here is just the baby boomers retiring. So this isn't a surprise or necessarily a indication of how the economy is currently doing or anything. A lot of it's just the demographics of our workforce. Now, certainly a strong economy, a strong labor market will put more money into Social Security as well. So there's a possibility these numbers will change. Everything going 21 forward is a projection. So certainly things do change some over time. And all of this is assuming that there's no changes to the laws regarding benefits and who pays in and how much they pay in. But what happens here when the line goes to the dotted line, and it looks like that's here going to be in about 2034, basically the checking account for Social Security will be empty. There'll be no more surplus to draw on from the past. So that's 12 years down the road from now. So what current law says is once that happens, Social Security will only pay out as many dollars as it takes in. So it'll just say, if we're short money, we're just going to reduce everyone's benefit by an equal percentage, and that's what people are going to get. So the Social Security system will never owe anyone any money in terms of it won't go out and borrow money to pay benefits. Instead, people are going to receive about 75% or 74. The number varies a little bit over time of your benefits. So if you were expecting to get $1,000, once that date goes by, you're going to get about 75% of that, or $750. So you will still receive a payment, but it might be less than you were expecting. Now, I think that there will likely be some law changes between now and 2034 that will improve this benefit payout ratio, but I don't know exactly what that'll look like. There's not a proposal that's immediately ready to pass or anything, but this is under current law. I would expect that Congress will do something between now and 2034, but we don't know what that will look like. All right, so other retirement savings, there's lots of different kinds of employer plans. I won't go into the details here today, but whether that's a 401k or 403b, or profit sharing plan, lots of different kinds, but you may have savings either from a side job or from a job you worked earlier in your career, or maybe that your spouse worked at, that might be available to help fund your retirement years as well. So defined contribution plans are certainly the most common and popular option for employers today. Oftentimes these are called 401k or 403b plans. That's just the IRS code section where the rules are written about how those plans operate. Typically the employee and the company contribute on a pre-tax basis, so they don't pay taxes on the money that goes into that. And then when the person retires and starts to withdraw funds from that account, then those are taxable earnings to them. So they're taxed one time, but it's during retirement as opposed to during their working years. In some cases, that means that people will be earning less money during retirement, which means a lower tax rate to be paid on those funds. So there are some tax advantages to participating in these plans. The investment returns for these type of plans are almost always the employee's responsibility. So company puts money for you, you make investment choices, and then whether they do good or bad is your sort of responsibility, and you get the benefit if things go really well. And if things don't go as well, that's up to you. The company's not going to put in additional funds. Defined contribution plans are a little bit challenging sometimes to think about. How do I think about that in terms of annual income? And just a quick example, we're going to use $100,000 because it makes the math a little bit easier. And that account is going to go up and down even during your retirement years based on whatever you're invested in. But you're going to get to determine how much you withdraw from those funds. So how much can you expect from an account like this? Well, obviously how much you start with matters a lot. How much you withdraw, how much you take out of the account, and are you still contributing? And then what are your investment returns going to be? So you will get to make some investment choices, usually in the form of mutual funds or a similar product. And usually there's somewhere between 6 and maybe 20 investment choices that are kind of broad categories of investments. I just a quick graph here to show you a couple of different kinds of investments. So first of all, the blue line here is the S&P 500 index return. So it's kind of a broad measure of how stocks have done. So you'll notice with the blue line, if we averaged it out, it would be higher than the others. But you'll notice also it also had the 4 lowest returning years over the last 30 years as well for this group. So you take more risk that things could go up and down. There's more volatility here. But on average, you're going to get a better return. That's kind of the argument for investing in stocks. The red line is a bond index. You'll notice it doesn't bounce around nearly as much, but the average earnings from bonds are lower. So less risk and then lower return. And then the last one here is a short-term bonds, which I'm equating to roughly what your savings account return would be. And you can see here that over the last, 15 years, savings account rates have been very close to zero, but always positive. So you're going to have some choices, and the mix of risk that you're willing to take and return will probably determine some of what your long-term investment returns will look like on your savings. Now, there's a couple different kind of methods that people can think about taking their money out. So one way to think about it is you're going to take only the earnings out of your retirement account to live on. So the benefits of this is you're never going to run out of money because you're only taking the earnings that were made on that particular account. Another benefit of this is you are likely to have funds, if you never spend the principal, that you're going to be able to designate through your will to go to an heir of your choice. Now, challenges with living on this is your income is going to vary every year, so you kind of don't know how much you can spend. This is also usually your lowest monthly income of the other options that I'm going to talk about. And then there is a point, and they just made some changes to it in Congress, but when you get into your 70s, there will come a point where you're asked to take out what's called a required minimum distribution. So you do need to take money out of IRAs and 401k plans. Starts at about 4% of your balance and then kind of inches its way up. Doesn't mean you have to spend it, just means you have to take it out of that tax advantage retirement account. So if you use this interest only method, there may come a point where you need to take some extra out to make sure you've covered your required minimum distribution. So quick example of what that looks like. If we have a $100,000 account, if it earns 6%, we get to withdraw 6,000. If it earns 1%, we get to withdraw 1,000 then to live on. Now, what if the account loses 2%? Now, this method's a little bit hard to kind of manage in that sense. You just take nothing out. But that's kind of the rough thought process for an interest-only withdrawal. I think what's a much more common method is something called the 4% rule. It's kind of a rule of thumb. I wouldn't call it an exact science. There is some research that's kind of been done about investment returns that kind of puts it in this ballpark, but here's roughly how you can think about the general terms is withdraw 4% in year one. So you retire, you have this $100,000 account, we're going to take 4% out. In year two, you're going to take that 4% out, plus you're going to add whatever the inflation rate is for the current year. My example here has 3% for inflation, so that would go up to $4,120. In year three, you would take that $4,120, add the next year's of inflation, which I put in at 4%. So you'd take out $4,285. So that's kind of the rough process for doing that. Why might you want to do that? One, you have a little bit more consistency in terms of what you have to spend. I updated our inflation averages here. And one thing you'll notice, it was pretty consistent at, under 3%, really for the last, 30 years, really under 2.5% almost every year. But in 2021, for the first time since the 80s, we saw a number over 5%. So we may need to think a little bit more carefully as we think about inflation going forward. It looks like in 2022, inflation is running high. It's unclear how long this period of higher inflation will last, but roughly we've had, kind of in the low 2% range, 2 to 2.5% range for inflation. I think my slides get caught up here. Yeah, so here's the inflation number that I was looking at there just a second ago. And then now the 4%, so we could do this 4% plus inflation that we just talked about. If we put in that average inflation number for 20 years and we use average stock returns for stocks, bonds, and CDs for 20 years, so kind of splitting your portfolio. In this case, after 30 years of withdrawing, so if you think about retiring at 65, this would be when you're 95, the balance of that $100,000 account would still be $93,000. So essentially, you're going to have about as much earnings as you were taking out, so the money didn't run out after 30 years. Um, Again, if we change this a little bit and we take less money in our stocks and put more into bonds and CDs, in this case, the money is going to last 33 years. So again, if you retire at 65, when you get to age 98, you will have run out of money. If you think about it, just at the 30-year, we'd be down to $16,000 of earnings. So we don't know what these future returns are going to be, but there's a pretty good chance using this method that you're going to have enough funds to last 30 years, which for many folks, that's often kind of a target number they're looking to fund. Another option, if you're really concerned about running out of money during retirement, is you can buy an annuity. I specifically mentioned here one called a single premium annuity. And essentially at this point, whether that money's in an IRA or just traditional savings, you're going to hand over a single payment today, or possibly maybe a series of payments for 10 years or something. But I'll talk about the single premium one. So I'm age 65 and I just want to give the $100,000 to an insurance company. And then they're going to promise to give me payments for my entire life. Or you can also make some adjustments for things like you and your spouse's life, or maybe a guaranteed number of years as well, like 30 years. They do all this based on actuarial tables, but if that running out of money is particularly concerning, this can be one way that you can guarantee that you'll have some retirement income for your entire lifetime as well. So that's just a tool you can utilize with your kind of bucket of money to turn that into monthly income. Let's talk a little bit about IRAs, which might be a little more attainable in some sense because you don't need to be attached to an employer, nor does the employer have to set up a plan for you. So there's two types of IRAs. Traditional IRAs, funds are contributed on a pre-tax basis, so they help your tax return currently. And then when you withdraw funds, that's taxable income. So taxed one time, but it's when the money is taken out. A Roth IRA lets you put money in after tax. And then when you withdraw those funds during retirement, that's going to be a tax-free withdrawal. So again, taxed one time, but it's during your working years. There is a 10% penalty. There's a few exceptions if you take that money out before you reach age 59 and a half. Nice thing about IRAs is you're not required to contribute every year. As we know with farming and ranching, some years are more profitable than others. So you may have more cash flow in certain years than others in wanting to contribute to an IRA. Traditional IRAs, the maximum amount you can put in is $6,000 per year per person. And I didn't update the year. That should be 22 for the tax year 22. And then you can add an additional $1,000 if you're over age 50. You do have some income limitations where if you make over these amounts, then you're not able to deduct that contribution into your IRA. But these limits don't apply if you're not covered by an employer plan. So these limits, only apply to folks that also have the ability to contribute to a 401k or 403b type plan. So keep that in mind. If you're not covered, then these income limitations don't apply. On the Roth IRAs, it's the same limit, $6,000 per year and $1,000 extra if you're over 50. And it is the same limit. So you can't do a $6,000 traditional IRA contribution and a $6,000 Roth IRA contribution. That would be a total of $12,000 and that would be over the contribution limit. You could do $3,000 into each. That would be fine, but it is a single contribution limit. Now, there are some income limitations for Roth IRAs, but they're much higher. So they generally don't catch near as many folks in terms of eligibility for these. The other thing that's a little bit different when we talk about personal savings for a farmer and rancher is oftentimes there's a lot of assets that they've built up. And depending on what you want to do in terms of transitioning your operation when you get to that point of retirement, some folks choose to think about having an equipment sale. And we've all probably been to a farm auction where people are liquidating their line of equipment, maybe selling off their herd of livestock, those kind of things, in addition to selling the farmland as well. And then we can think about the land. Are we gonna, if you're not gonna farm it or ranch it yourself, are you gonna lease it to someone? maybe someone within your family. Maybe you're going to sell that operation. One thing to think about too, if we're going to sell it, are you also selling your home? Well, we need to take some of those funds to purchase another place to live. So if we're thinking about renting it out, Montana Ag Statistics, which is part of USDA, they do publish statewide numbers, and these is a 3-year average from 2019 to 2021. And then, so what we have here, irrigated cropland is going for $85 an acre, non-irrigated is going for $28, and then pasture land for $6.83 cents per acre. These are statewide averages. They may or may not reflect local area conditions in your area, but it can give you a little bit of a benchmark if you haven't thought about it in terms of what your land might bring for you in terms of income if you stepped away from running your operation. Montana Ag Statistics also publishes information about land sale prices for ag land. Irrigated land, again, for the most recent 3-year periods, running about $3,000 an acre. Non-irrigated land, about $835, and then pasture land in that $675 range. So again, thinking about what land you own, if you were to liquidate it, how much cash would it generate? There are some capital gains possibilities that could take some of this. There are some exemptions for things like your home, and depending on what you've depreciated in terms of fixed assets to that as well. And then don't forget about, if you do choose to sell it, will you be using a real estate broker to deduct their fee? 7% is somewhat common for the real estate industry, but it may be negotiated to less than that as well. Another thing to think about is just working in retirement. Sometimes people work during retirement because they need the income or would like that extra income. Others do it as a way to be involved, where they still enjoy what they're doing. Some like the flexibility of part-time work. They still want to be engaged. They just don't want to be tied down to maybe the long days or the every day of the week kind of things. We also see folks that work because their employer needs them. Right, so maybe you've turned the operation over to your son or daughter, but they really need some help during harvest and calving. And even though you don't need the money, you want to support them in their new operation, so you continue to work in that sense. So, and then we've also seen folks that retired, but they've always wanted to do something they really like, and they're not that concerned with the pay. So maybe you want to, at a colleague that I knew that worked at a much higher stress job, and when they retired, they helped out, and they did some driving for a couple different companies. No stress, didn't make a lot of money, but they liked what they were doing. So that's great too if you can find something like that. So a lot of different reasons that people work during retirement. What can you do to increase sort of your retirement security? So if you think you're not getting towards whatever those goals might be, certainly working longer gives you more time to save, but also less time to spend as well. So that's kind of helps in two different dimensions there. And then another thing is to save more while you're working. If you see that you're 10 years from retirement and your path to the retirement that you think you want to live isn't going to get there, maybe cutting back now on some expenses so that you can save a little bit more will help you get to that retirement date and live those years in a way that you want to. Thinking about what activities you're going to do during retirement. Maybe you're going to give up traveling or eating out at restaurants. Lots of different things to think about in terms of being able to do the things you want to do and still having enough funds to do those. And then we talked just here a second ago about working during retirement, whether that's full-time or part-time. With the most recent job market, I think if you'd like to work, there's plenty of places that would like to have you in a lot of different capacities. So. And then another thing to kind of think about too is what kind of things do we want to downsize with? Do we need to have 3 cars if it's just a household of 2 people? Am I willing to give up that extra car, which would generate cash, but it also something then that you're not paying for insurance on and repairs and, license plate fees, those kind of things. So do you want to downsize to a smaller home? All of those kind of issues are different things you can do to kind of increase your financial security during retirement. So my kind of takeaway messages is just going to be this. Retirement planning can kind of be overwhelming. Um, I wouldn't think about trying to do it all in one sitting, or the fact that you think, you mentioned 14 things today and I only have time to do two. Um, you know, do two and then come back in 6 months and maybe there's another one you can do. It's a process. But one thing about this is, you're in charge of this. Nobody's going to do it for you. So it's really up to you to kind of put yourself on a path to get you to where you want to be. So, and if you're 20 years old, it's not too early to start. And if you're 70 years old, it's not too late to start that process as well either. So get started, take a step or two at a time, and keep plugging away at it. And I think you'll have a lot better chances of getting to meet your retirement goals. So I know we mentioned a lot of things today. There's my contact information. I'm happy to handle follow-up questions. But if you do some things for your retirement planning, I think you've got the opportunity to, enjoy your retirement years more and be more financially secure during those years, and possibly also incorporate this into a family transition plan too for keeping that operation in your family farm. So again, if you have any questions, please reach out to me.